Hello, friends. If your home is paid off, Centrelink treats you differently. Most pensioners don't know. Have you spent decades paying off your home? No mortgage, no bank debt, no monthly repayments? Most Australians see that as the finish line. But what many retirees don't realize is that the moment your home becomes fully paid off, Centrelink starts looking at your finances differently, and in some cases, that difference can mean thousands of dollars in age pension payments gained, reduced, or completely missed. And here's the surprising part. For some pensioners, owning their home outright actually improves their position. For others, it quietly creates rules they never knew existed. That's why today we're going to break down exactly how Centrelink treats homeowners in 2026, why the asset limits are completely different depending on your housing situation, and the costly mistakes many retirees make after paying off their mortgage. By the end of this video, you'll know what Centrelink sees when it looks at your home, what it doesn't see, and what you should be checking immediately if you're receiving the age pension or planning to apply soon. And here's the short answer right away. If your home is your principal place of residence, Centrelink generally does not count its value under the age pension assets test. However, because you're classified as a homeowner, you are subject to lower asset thresholds than someone who doesn't own their home. That single distinction changes everything. Before we go further, make sure you're subscribed and turn on notifications. Centrelink rules change regularly. Asset thresholds move, income test rules change, deeming rates change, payment rates are indexed, and every year thousands of retirees discover important updates only after their payments have already been affected. On this channel, we break those changes down into plain English so you can understand what they actually mean for your retirement. Now let's look at why owning your home outright creates a completely different Centrelink category. The homeowner rule most pensioners never fully understand. Ask 10 retirees whether Centrelink counts their house and you'll often get 10 different answers. Some believe their home is included, others think Centrelink ignores it completely. The truth sits somewhere in the middle. For most age pension recipients, the family home is exempt from the assets test. That means a person living in a modest suburban house and a person living in a property worth several $1 million may both have the home excluded from their age pension asset assessment. That's the good news. The less obvious part is what happens next. Centrelink then places you into the homeowner category. And homeowner categories have lower asset thresholds than non-homeowners. In 2026, a single homeowner can generally hold up to around $321,500 in assessable assets before their age pension starts reducing. A single non-homeowner can hold around $579,500 before reaching the same point. That's a difference of roughly $258,000. Many retirees hear that their home isn't counted and assume they're automatically ahead, but Centrelink has already adjusted the rules to reflect the fact that you own somewhere to live. That's the first major misunderstanding. Now let's talk about the second one, the hidden advantage some retirees accidentally create. Imagine two retirees. Both have $500,000 in financial assets, both are single, both are 67 years old. One owns a home outright, the other rents. Many people assume the homeowner is automatically better off. Not necessarily. Under Centrelink's asset test, the renter may qualify under the more generous non-homeowner thresholds. The homeowner is assessed under the lower homeowner limits. This surprises many Australians because they assume the house itself creates a disadvantage. In reality, Centrelink is trying to balance housing security against liquid assets, and this distinction becomes incredibly important for retirees who recently sold a home, downsized, or moved into retirement accommodation.
One paperwork error can place somebody into the wrong category, and once that happens, their pension assessment can be completely different. That's why homeowners approaching retirement should periodically review how Centrelink currently classifies them. A surprising number of people assume the system has recorded everything correctly. Sometimes it has, sometimes it hasn't. The renovation opportunity many pensioners overlook. Now let's move to something many retirees never hear about. Suppose you have significant savings sitting in the bank. You are close to an age pension threshold. You need major work done on your home, a new roof, accessibility modifications, bathroom upgrades, electrical work, energy-efficient improvements. Here's where things become interesting. Money sitting in bank accounts is generally assessed as an asset. Money legitimately used to improve your principal residence may move from an assessable environment into an exempt environment because the family home itself is generally exempt. This is one reason financial advisors often tell retirees to think carefully before leaving large amounts of cash idle while their home needs essential upgrades. The decision should never be made purely for pension purposes, but many Australians fail to realise that improving an exempt asset can produce very different Centrelink outcomes compared with simply leaving funds in a savings account. With energy costs, insurance costs, and maintenance costs rising across Australia, this is becoming a bigger consideration every year. Now let's discuss a mistake that catches many homeowners completely off guard: when your land starts counting. Most people hear that their home is exempt and stop listening. That's where problems begin, because in certain situations, parts of a property may still be assessed. This is especially important for retirees living on large rural blocks, acreage properties, hobby farms, or regional landholdings. Many Australians spent decades building their dream retirement property. Then they apply for the age pension and discover that not all land is treated equally. Depending on the circumstances, some land beyond the principal home area may be assessed differently. The result? A retiree who believes their entire property is exempt can suddenly find themselves facing a much larger asset assessment than expected. For regional Australians, this is one of the most important Centrelink topics to investigate before lodging a claim. Waiting until after an assessment arrives can create enormous stress. Let's move to another area where paid-off homeowners often make costly assumptions: the downsizing trap. Over the past few years, many retirees have considered selling larger homes. The logic sounds simple: sell the family house, buy something smaller, pocket the difference, enjoy retirement. But Centrelink doesn't simply look at the transaction and move on. The proceeds can affect your financial position in ways many people never anticipate. Imagine somebody sells a property and suddenly holds several $100,000 in cash while deciding what to do next. That money may be assessed. It may influence asset calculations. It may affect income test outcomes through deeming rules. And depending on timing, it can alter age pension eligibility. This doesn't mean downsizing is a mistake. Far from it. For many Australians, it makes excellent financial sense. The problem occurs when people focus entirely on the property sale and never examine the Centrelink consequences beforehand. A decision worth hundreds of thousands of dollars deserves planning, not guesswork. Now let's look at a group particularly vulnerable to these rules: widows and widowers living alone. One of the fastest growing groups in the retirement system is homeowners living alone after losing a spouse. Many of these Australians own their homes outright. They have limited debt, they have some savings, and they assume their pension situation is straightforward. Unfortunately, that's not always true. When household structures change, Centrelink assessments can change. Income positions change. Asset positions change. Concession eligibility can change. Even payment rates can change. Some widows and widowers continue operating under assumptions that made sense when they were part of a couple, but no longer apply to their current circumstances. If you've experienced a major life change in recent years, it may be worth reviewing every aspect of your Centrelink record rather than assuming everything automatically updated correctly. Now let's discuss one of the biggest misconceptions in Australian retirement planning, the million-dollar home myth. Every year, people ask the same question: how can someone live in a valuable home and still receive the age pension? The answer lies in understanding what Centrelink is actually measuring. The age pension doesn't simply examine wealth the way many people assume. Instead, it applies specific rules to specific assets. For most retirees, the principal home receives special treatment. That's why somebody living in a highly valuable residence may still qualify for payments, while somebody with substantially less overall wealth but large accessible financial assets may receive less. To many Australians, this feels counterintuitive, but it's a feature of the system, not a loophole. Understanding that distinction helps explain countless pension outcomes that otherwise seem unfair or confusing. Now let's talk numbers that every homeowner should know in 2026, the thresholds worth checking today. As of the March 2026 age pension asset test settings, a single homeowner can receive the full pension up to approximately $321,500 in assessable assets. For couples who own their home, the combined figure is approximately $481,500. Once assets move above those levels, pension payments begin reducing under the assets test. For homeowners, age pension eligibility cuts out entirely at much higher levels, reaching around $722,000 for singles and approximately $1.085 million for couples combined. Those numbers matter because many retirees focus only on whether they qualify. What they should also be asking is whether they qualify for more than they're currently receiving. Thousands of Australians sit near these thresholds without fully understanding how small financial decisions can influence their assessment. And remember, Centrelink applies both the income test and the assets test. Whichever produces the lower payment is generally the one that determines your entitlement. That's why understanding your homeowner status is only one piece of the puzzle. Here's what you should check this week. If your home is fully paid off, there are 5 things worth reviewing. First, confirm Centrelink has correctly recorded your housing status. Second, review your current asset position rather than relying on old estimates. Third, examine whether major cash holdings are affecting your assessment. Fourth, understand how any future downsizing plans may interact with Centrelink rules. And fifth, if you're living on a large property, investigate whether any land outside the normal exemption arrangements could affect your entitlement. None of these checks take long, but ignoring them can create consequences that last for years. Final thoughts. So let's bring everything together. If your home is paid off, Centrelink does treat you differently. Not because your house is automatically counted, but because owning your home places you into a separate category with its own asset thresholds, assessment rules, and pension calculations. The family home is often exempt. Your bank accounts are not. Your investments are not. Your financial assets still matter. And understanding the difference between homeowner and non-homeowner treatment could mean the difference between receiving the correct age pension entitlement and receiving less than you should. Most retirees spend decades focused on paying off the mortgage. Very few spend time learning what happens after the mortgage disappears. Yet that's exactly where some of the most important Centrelink rules begin. If you've found this helpful, subscribe to the channel, turn on notifications, and share this video with another Australian retiree. Because someone you know may own their home outright, believe everything is sorted, and have no idea that Centrelink is assessing them under an entirely different set of rules.